Payday and Title Loans. Before we begin, I do have a couple of housekeeping items. First, please, right now, mute your phones so we won't have serenades from happy puppies or annoying cell phone rings. I really appreciate that. Secondly, you may well have questions or comments or things to discuss this evening, and we certainly welcome those. We would like for you to hold those until after the presentation is complete. There should be ample time in this hour for both the presentation period and the discussion part. So if you would please put any questions or comments you have during the presentation in the chat box. My co-president, Julie Steiger, will be monitoring that and sharing those questions with you afterwards. And of course, during that time, we'll ask you all to unmute if you like to take part in the discussion. Now that we have that part out of the way, I'm pleased to introduce the speakers representing our league this evening. They are Kelly Nichols, Shelby Butler, and Ann Elwell. Also serving on the committee, but couldn't be here tonight, were Teresa Pope and the committee chair, Marjorie West. And Shelby, the microphone is now yours.
Hello, welcome to our presentation tonight. I'm really excited to be a part of this and just to share some of the work that we did to present it to you today. Basically, the purpose of this study was to create a position statement. There was no national or state League of Women Voters position on payday loans. And so our board in the Southwest region, after we completed this, has accepted it, and we were asked to present this. So just really exciting to share this with you. We did take 11 months to do this, and I can vouch for, the time that we put into it to really look at both sides, to look at our service area or our counties, which are Greene, Christian, and Webster, but to try to tie it into a statewide approach so that we really can finally kind of look at this and do something about payday loans. There has been recent activity at the state level and with even our Springfield area. We're one of the largest cities, Springfield is, within our counties, but we need a statewide position to really do anything about it, because even at the local level, there's just not much that we can do. We researched national and state league positions. One of those that we looked at that had been approved was in Texas. We established a timeline, and so, like I said, 11 months later, we kind of came up with what we have tonight. Historically, you may already know this because a lot of us have shared even before we started that this is definitely an issue that we probably all see maybe as a problem or just maybe as something where we need to really look at this and figure out if something needs to be done. But short-term lending is not a new idea. Even more than 100 years ago, there was a mass market for consumer credit that didn't exist, and salary lenders that offered like 1 week loans at annual percentage rates of like 120 to 500% came about. And even in the early 20th century, the Russell Sage Foundation, it was an entity devoted to progressive social policy, started pushing regulations on these loans because there was a lot of people being taken advantage of. And so they promoted a model, the Uniform Small Loan Law. And by 1940, 34 states, including Washington, D.C. and other entities, had small loan laws. But federal deregulation of the financial institutions in the 70s and 80s just allowed lenders of all types to kind of ignore these laws. And that's where we are today. We have the payday loan industry, which has really grown quickly. And looking at both sides, we're going to kind of go over some of the pros of this industry that allows people to get money when they need it, but then some of the cons. So looking at the next slide, we looked at the stakeholders and the borrowers. I think someone made a comment, we had the report available to go through if you were able to look at it. But we looked at the Pew Charitable Trust And in 2018, it was reported about 12 million American adults used payday loans annually. So that's quite a few people. And on average, the borrowers earned about $30,000 per year. And most of those loans were to cover just ordinary living expenses. But over the course of months, people borrowed quite a few loans, and many were indebted for 5 months or more. And so that results in a lot of interest. Paying $520 in finance is charged for sometimes just a loan of $375. So that kind of tells why these loans are attractive. People may need them on an emergency basis. They're able to show that they need that and they have the money to pay it back. But when it comes time and the interest accrues, a lot of times they're not able to do that. Most borrowers are white, female, and from age 25 to 44. But again, we talked about that for a few minutes before. I heard some people surprised at that. Those are national numbers, and sometimes, we're not sure how those are reported, but there are other groups that have been kind of targeted, those without a four-year college degree. So maybe they're lacking knowledge of, some of those skills that you learn while you're in college, or even how to budget or finance while you're in college, because I know that's when I accrued a lot of debt. Home renters, African Americans, and those earning below $40,000 a year. And then those who are separated or divorced. So that's a life change, that can occur and cause an emergency. It was reported also that 69% use the loan to cover a recurring expense like utilities or credit card bills, or things that they should have the money to pay for regularly. So these were some of the things that we took into account. When you apply for a payday or an auto title loan, if you've looked into it, it's very easy to do. You provide a paycheck stub if you have a job, an account statement from your checking or savings account, sometimes a personal check and a valid driver's license. So it's pretty simple to even use other people's information in some situations to apply for these loans. And then just the interest rates, the repayment rates, increase as more time goes by. And like the study showed, even at 5 months, people were paying, almost double the amount that they borrowed. When we did the research, we also looked at personal stories, and that is included in the appendix in our report. We looked at a full-time college student who worked full-time but earned low wages, and then just used those title loans to pay off some of those regular expenses, like was mentioned in our last slide. But then just kind of got out of hand and had to take out credit cards, which ended up resulting in, filing bankruptcy. So that, of course, affects people's credit. It really affects their future as a young person. And so these loans are so attractive when you really need the money, but long-term, they're affecting people's lives. Another story was a woman whose daughter was, unfortunately using, drugs and alcohol, and just in a desperate situation, used her mom's identity online to take out all these different payday loans without the mother even knowing. And she ended up in a rehab facility, and the mother ended up all of a sudden having these loans that were in her name. So very unfortunate situation, and had that been, not as easy to get, maybe she wouldn't be where she is today. Another person, a woman who has a disability, depends on a caregiver, somebody who's also working a low wage job, who's taking care of someone on a fixed income, takes out payday loans to pay rent and utilities, and suddenly can't come to work because she doesn't have gas in her car. So the woman with a disability who's relying on this caregiver pays off her payday loan so the caregiver can work for her. So just some really unfortunate situations that happen because these things kind of get out of hand. And so those are really important personal stories to share as a big part of this. We also looked at the lenders, because there is, of course, always another side to every story, and we don't want to be one-sided. The lenders think that they're doing a good thing. Customers are satisfied with their loan experience. We did talk to one person who actually did use the loans in a responsible way. He was a truck driver, and he needed the collateral, I guess, to buy, whatever it was to deliver, and then he paid it back when he was paid for the job. So there are some stories and circumstances where people are using these. And so the loan providers hear this and they think they're doing a good thing. They feel like, people are able to get these loans despite bad credit or low credit scores. So they feel like they're kind of filling the gap for those people that couldn't go to a bank or another provider to get this money. They have convenient locations, they have long business hours, immediately you can get access to cash, and they feel like their agents are friendly. One of the stories we did include as well was someone who did work at a payday loan business. And he did share that he was given a lot of incentives and motivation to keep people paying on larger loans. And so that was kind of discouraging to hear that side of it, that he did say that was encouraged to try to get a long loan contract. So just knowing that people can't continue to pay those interest rates to keep them paying the monthly fees. But a Pew survey found that most of the borrowers surveyed said that payday loans did take advantage of them, while at the same time, a majority also said they provided relief. But the study also showed that despite their concerns how the loans worked, the majority would seek them out again. So we know that people come back to that. And just something here on our slide to kind of show Missouri, we have 299 McDonald's restaurants and 1,257 payday loan locations. So just to kind of show the vast mass of these places where people can go to get this money. So 958 more locations than McDonald's, which ranks us at number 5 in the country for the number of payday loans. And with that, I think I will turn it over to Kelly.
Thank you, Shelby. So as Shelby has already laid the groundwork, I will just say that idealistically, our committee probably went into this thinking, well, we're going to find that payday loans are bad. And what we learned through this is that payday and auto title loans are probably necessary. And when we look at the demand for them, I mean, Shelby already gave an idea that we know we have plenty of lenders, and just looking in the 3 counties that we did the deep dive into, we have 24 payday loan companies in Greene County, 3 in Christian, 2 in Webster, 69 auto title loan companies across all 3 counties. In 19 and 20, Springfield issued 32 licenses. Can't really explain, there's a little bit of difference there. And the timeline of demand, the number of licensed lenders peaked in 2005, and there are half as many now. So what we know, if you'll remember from like 07, 08, the mortgage crisis, all that, we had a peak of people utilizing them. And then we did have some action from Congress and such, trying to get a grip on lending and not allow people to borrow more than what they can pay back. So there has been some reduction in the number of storefronts available across the last 10 or 15 years. But the internet has changed a lot of that, because even if they don't feel welcome, even if they're not getting the action that they need to be viable with a storefront, the internet, now we have companies that are not even based in our state. The internet loans have tripled from 2012 to 2017. And those, even states that have tried to put more regulation on, it's hard to fight what people can get on the internet. So here's kind of how the loan works. And we have, Missouri, our regulation is not great, but at least it does have some cap. So in theory, this is just an average payday loan at a storefront in Springfield. If you go in and you borrow $500, you will owe $595 2 weeks later. Well, That's $95 for 2 weeks. If you annualize that, that is the same as a 494% interest rate. But see, it's hidden. It's not completely hidden because it is in the small print at the very end of what the borrower is looking at, because they are required by law to tell the truth about their annual interest rates. But what the person sees is the absolute dollars. So it's like, okay, well, I need $500 right now. And when I go back in 2 weeks, I'm going to have to pay an extra 95. And they think that seems doable. I'll work a lot of shifts between now and then. That seems doable. But $95 for $500 for 2 weeks is 494% of interest. Now, Missouri does have a cap. Missouri says you can't pay more interest than 75% of the amount that you borrowed. So what that means is that our payday lenders in Missouri really can only give you two-week terms. And then they're maxed out. So they're going to have to, if it's an auto loan, they're going to have to take your car. They're not going to be able to extend you terms. You will have to pay it off. So we can see how it grows astronomically, but in theory, Missouri does have a 75% cap on the fees that you pay relative to the original amount that you borrowed. Auto loans have no cap or fees because they don't care, because they're going to come get the car. Okay, now, then we started thinking, we need to look at the demand. Well, this is not a statewide information, but this is about our 3 counties that we did the deep dive. And you can see that we have high poverty rates, particularly in Greene and Webster County. In Greene County, we have 42% of people renting rather than owning their homes. And Shelby had mentioned early on in the intro that the profile of the average person that uses payday and auto title loans are renters. And then we did a breakdown on free and reduced lunch. So in Christian County, we've got somewhere between 31% and 55% of children on free or reduced lunch. In Greene County, we are running between 33% and 53%. And in Springfield, where there are so many storefronts, 53% of children are on free lunch. And then Webster County, we've got 48% of children on free lunch. So we know the demand is there for people that don't have a lot of alternatives. So when we look at Missouri compared to other states, it's really interesting because we actually have 12 states that have eliminated payday loans entirely. And we looked pretty hard at Arkansas, and Arkansas really believes that they have done a good job of creating a culture where people are trying to find another way to solve their problems. But one thing we learned was that because of the internet lending, just because your state outlaws payday loans doesn't mean people aren't getting loans. What it means is that they are borrowing over the internet. And so they are borrowing from companies that don't even have any stake in your state. They're not there. The profits are not being circulated in your state at all. It's actually draining a lot from states. So when you eliminate payday loans entirely, that's not a positive thing for the state either. And then there are 6 states that have no limits on payday loan fees or interest rates. So in Missouri, we do have some regulation and we do have some caps. We're kind of toward the bottom on how aggressive the companies can be, but we do have states that have absolutely no regulation at this point. When we look at other cities, and some of you, we were kind of talking a little bit about St. Louis, for example, before everybody got on. St. Louis has really worked hard to attack the payday loan situation. They have required $5,000 annual license renewals. So that's pretty steep. I mean, a company would have to think about that as a fixed cost each year. And they have really, really good regulation on signage and the information that they have to provide the lenders. So St. Louis has been pushing hard, but we're limited by what we can do because we can't do a regulation, an actual regulation that is stricter than the state. We can do these licensing fees and signage and all that, but we can't change the interest rate caps beyond what the state has done. Kansas City and Liberty, Missouri have worked hard to emulate what St. Louis has done. And then Columbia is in the middle of trying to adopt something very similar. And in Springfield, we've had a task force working on it. And actually, Marjorie, our chair of our committee, she served on that task force. And so did Janet Dankert. And we're working on it. But like Shelby said, there are a lot of things at play right now. At the federal level, we've got the Consumer Financial Protection Bureau. It's kind of a one step forward, two steps back thing. For the Frank Dodd Act from back at 2008, when we realized that we were really cheating people because of the way we let them over borrow to buy their homes, and then they were upside down when the recession hit and they owed more than their home was worth. We thought that some of that regulation would actually do more than it did. And so we still have a lot of work to do, even at the federal level. So in the state, we do have some regulation. The maximum loan amount is $500. Like I said before, we've got that 75% of the initial loan amount as a cap for payday loans, not for auto title loans. On auto title loans, the maximum loan amount is $5,000. There's no cap on the interest and finance charges. And defaulting on a payday loan in Missouri is a civil offense, not a criminal offense, which, I mean, that's good. We don't want any of our people that have to default on a loan to have a criminal record per se. So that is probably a more positive thing about our state regulation. I already mentioned before that we've got in Springfield, we've got a task force working on this, and we had 2 of our members serve on that. But again, the cities cannot do something more aggressive about the fees or the terms. They can employ, like St. Louis did, where they have a steeper license. They can employ signage. They can do all those things, but we can't do much. It has to be done at the state level. And at this point, I'm going to turn it back over to Shelby to talk about policy options.
So yeah, we took all that information and background and really looked at what kinds of options do we have. So of course, we were only looking at a 3-county area, which really didn't give us a lot of options. Like Kelly said, the Missouri state law prohibits changes to the regulations. So we really need something enacted by the state to really make, especially in small communities, some big changes. But we know that members would prefer us to compose a position statement, that was applicable to our counties and then present it. So examples of policy reform, just to kind of get us thinking if it was adopted, continue the operation of payday and auto title loans under the current state law and administrative regulations. So that would be the current 75% cap and the 6 rollovers maximum. We know that people are saying they want this money when they need it. And so that is one way to allow that. Enable a small dollar loan market that maintains affordable credit while safeguarding consumers. And I think that's, from my standpoint and our committee, that's one of the reasons that we wanted to do this, because the ultimate goal is to protect consumers. Like I said, the story from the man who worked at the title loan company, was he really asking if people could repay or just hoping that they couldn't so that they could make money? So we really want to make sure that people can repay the loan and cover the basic expenses without borrowing again or without going to another source. Because like Kelly said, if you take it away, people may look at other options for getting that money because sometimes there are emergencies. A loan is generally unaffordable if payments exceed 5% of gross periodic income. So similar to like affordable housing, 30% is affordable. There are, minimums that people look at to really decide if someone can pay it back. Colorado actually went down to 45% interest cap, but then allowed additional fees to increase lender revenue. So there could be ways where the loan companies could still make money, but then the interest rate is capped a little bit lower. And then the third one was just prohibit all payday and title loans, auto title loans whose combined interest and fees exceed the limit set by the Military Lending Act. And we did describe that in our report. It was on page 11. It was revised in 2016, but basically it was designed to protect active duty military members, their spouses, and dependents. And so there's a 36% rate cap, certain finance charges, add-on products sold in connection with credit. So that does lay out some guidelines that could be used if that was, something that we felt was doable in Missouri. So with the next slide, we will look at the approaches to reform. Establishing an affordability threshold. So like I said, kind of setting up a way to determine whether a borrower can repay the debt, which could greatly improve the odds of not having to have them roll the loan over or to get another loan. Like I said, with this story of the mother, I think the daughter had taken out 3 or 4 different loans, and I'm sure each company maybe wasn't aware of the other. So just really looking at whether people can pay that back so that they don't do that. And then just establishing an affordability threshold where people wouldn't incur new cost. Borrowers already provide proof of income. They're already showing what their available money is. So, we don't think that would be too difficult. Colorado law effectively established a threshold of approximately 4%. And then the Pew Charitable Trust recommended a 5% threshold. So there are some recommended thresholds on affordability that we could look at. And then limit the amount, number, and/or financing of small dollar loans. Like I said, if a person can take out several, that just really starts adding up. Several states actually track that. They look at the number of loans per borrower. I don't know exactly how that looks, if they have a database or what that does. But in the 3-year period after Washington did that, they limited borrowers to 8 payday loans per year. They had substantial decreases in the number of loans, borrowers, and storefronts. So they felt like that worked for them. Missouri doesn't allow a payday loan with another payday loan. So that is one thing that Missouri has going for us, but there's really no tracking mechanism to set that up. So I don't know that that's really effective. Another approach would be regulating the collection practices. Frequent electronic withdrawal attempts by lenders from borrowers' bank accounts can lead to multiple insufficient fund charges. I think this probably happens a lot. People take in a blank check and they say they'll have the money in 2 weeks, and then the lender automatically withdraws it and that person didn't have it. Well, that still goes through the bank. And in addition to the withdraw negative, now you have charges on top of it from the bank. So people are in a really, I don't think people understand that that's going to happen. So the bank is actually charging on top of the payday lender. And limiting the allowable number of withdrawals could prevent this practice. So that is another way to reform. And then another would be removing or regulating the incentives for lenders to push for refinancing. So prohibiting fees for early loan repayment. When a loan is repaid early, require that fee funds be prorated instead of still making them pay the whole amount back. Prohibiting non-refundable administrative fees too for issuing loans. So just really putting some strict guidelines on the lenders so they're not taking advantage with all these extra things on top of it. And then just restructuring the loans. Loan restructuring converts lump sum repayment to installment payments over time, making it more affordable so that people actually can be realistic and pay the loan back. It's not bad to get a loan. We're not saying that it's not okay for people to borrow from a lender. But this approach could offer more affordable loans, which, like I said, really in the end, it's about the consumer and just protecting them. But when payday loans go away, you know, like I said, and what Kelly said is that we've realized people do need maybe a source for emergencies or ways to pay whatever it is they're facing. But what would people do if there were no lenders available? And several states that have either prohibited or limited the interest rate to 36% or less did follow-up studies and conducted surveys to get an idea how people handled crisis. Montana, and like Kelly said, we looked at Arkansas quite a bit. They did that. This was 2010, but Montana voters did approve the 36% cap. And then as predicted, most payday loan storefronts disappeared because they just didn't have that way to make money. But the internet loan sales soared, like she said. I mean, that really has become kind of the backup for all those companies to be able to offer that online. And so those spiked at more than 100 a year, and then the number began to kind of plummet. They totaled about 7 in 2016. So then what looked like a crisis actually turned around. There was an adjustment period. So when you do pass something at that level at the state, you have to kind of wait because it might balance itself out. And people began to turn to friends, to family, and they went back to kind of what people did before all the payday loans. So that was a state that we felt was, you know, successful in some ways. Arkansas prohibited loans in 2009. They capped the interest at 17%. And then 7 years later, they surveyed almost 2,000 borrowers and they got about 100 responses. And the people did say that they went to family and friends, they did get credit cards, they did go to pawn shops, but they felt like 8% said they were worse off, but 59% of people said they were generally better off after payday loans left. So, you know, people did say that they were okay with it, over half. So Arkansas was a good state to look at too. And then the long-term solutions, you know, education is key. I work with a lot of people who have disabilities, and I know personally, you know, there is a barrier to getting that education that you really understand. So you might see a commercial or a storefront that looks like a quick fix and you don't really understand. The people that are working there are not explaining it at your level to understand what's going to happen. So really making group or one-on-one budget counseling available, not just in our area, of course, but all over the state. And I know good things are happening in St. Louis. We have good examples here in Springfield too. We have the Northwest Project, which they do a lot of budgeting and really helping people find alternative ways to pay those needs when things come up. And then Consumer Credit Counseling, University Hope. So we have some good examples that are already in place that we could look at that are already set up to provide that education. And really someone could Google search free financial counseling to figure out in their area what's available. So it's already there. We just need to maybe tap into it to make sure that's a part of this whole process. And then payday loan alternatives. That's another thing we have here. They can only accommodate a limited number of borrowers. Borrowers must be closely vetted because the alternative businesses cannot afford any defaults. So we have a program, it's University Hope through a local church, and they work with borrowers that have they're already in the debt trap. So they were already, behind on the payments, and they probably ruined their credit, and now they need, some way out. So this is kind of an alternative where they take out a credit card and help the person kind of pay back that loan and rebuild their credit. But it is promising that there are other examples like this. And so we just know, along with the education, these program examples are there, and we just need to look to those as maybe solutions. And some states have found ways to protect borrowers while allowing the lenders a reasonable return. So again, with that education and just really making sure that people understand before they take out these loans, it is so important. And moving forward, we just need to kind of look at what's already been successful. And I think with that, it's back to actually Anne.
No, it's back to me.
Oh, it's back to you. Sorry.
So here's the thing, moving forward, we are excited that our chapter adopted a position, because we know that we can work with city council, we can work with the county commission. We know that we can do those things, but we also know that we are somewhat constrained by what we can do. And that is why we were excited to bring it forward as a proposal for statewide consensus, because we're excited about it. We're excited about our findings. We really believe that we want to advocate for people to have fair lending, which will benefit them in every other area of their life. We did pose a series of consensus questions to our league. And if you looked at our report, which I know a lot of you did just from the conversation we had before we all got on tonight, those are on page 18 and 19 of our report. And so after we compiled the results of how our chapter responded to the consensus questions, we ended up with a series of pros and cons to the issue. On the pro side, having small dollar loans available to Missouri residents is necessary. We've established that we are always going to have people that are struggling. We are always going to have people with emergencies. And it's unrealistic to think that we could do away with a system where you can get a loan quickly when you need it. Unregulated or inadequately regulated small dollar loan businesses can lead to unfair lending practices and exorbitant interest rates. And we have seen examples of how you can become buried in the interest and never dig your way out. States with little regulation find cash flowing out of their state due to internet lending and nationwide businesses with little interest in the well-being of Missouri. And like Shelby said, if we could create some alternatives, then we could have people who are interested in the economies and the well-being of families in our own state working on this. On the con side, companies say that too much regulation will drive them out of business because these loans are risky and lots of people default on their loans. And that's why the interest rates are so high, because they can't make it on a normal interest rate, because so many people will default that they need the high interest rates to offset that. So we know that, we understand that. And this type of lending is harmful to consumers. We need better financial education. A lot of people say, why are we attacking? This is a free market society. Why are we attacking them? We need to go to the root of the problem and just have better education so that they won't be so attractive. So our final position in a nutshell is that the League of Women Voters of Southwest Missouri supports policies, ordinances, legislation, and programs that allow a small dollar loan market that maintains access to affordable credit while safeguarding consumers. And at this point, I am going to turn it over to our colleague, Ann, who's going to talk about developing a position throughout the state of Missouri.
Thanks, Kelly. As Kelly and Shelby have shown us, and as our study committee knew going into it, as probably all of you know, to really impact the effects of payday loans on the citizens of Missouri, we really need statewide regulations. We need changes at the statewide level. Doing it, and we did it in response to the Springfield City Council getting ready to address payday loans. So we quickly found that we really didn't have a position that would adequately allow us to speak in favor of regulation or new regulations or changes. So we, after our study, and certainly going into our study, we realized that this needs to be a statewide change. And that's why we are coming to the state convention to ask for concurrence with our study. Let me talk a little bit about some of the inherent weaknesses of any local league position relating to payday and auto title loans, and how a statewide position would alleviate those weaknesses. First, a local league would need to address city councils, boards of aldermen, county commissions individually, and then find general agreement among all these entities to achieve a consistent lending policy. And those of us who volunteer for the league know how much time that would take to actually do all that coordination within our league service area to end up with something that would be solid. And then much of the legislation regulating these small dollar loans occurs at the state legislature level anyway. Local regulations can be overruled by the state. Loan companies still would have the ability to move outside of the local league city boundaries and set up shop anyway. So it really needs to happen at the state level. Having a policy position as part of the League of Women Voters of Missouri program would enable league members throughout the state to advocate in the General Assembly, to advocate for fair lending practices. And with state regulations, payday and auto title loan companies can earn profits that are fair, both to the companies and to the consumers. State incentives and programs also can allow the creation of other lending programs outside these for-profit companies. We mentioned a few of those, but access to banking among lower income individuals, not-for-profit lending groups. I understand St. Louis has something along those lines. Consumer education, Shelby talked about, and other assistance could be established statewide. And then consumers who can pay their bills without spiraling into debt would contribute more to Missouri's overall economy. They'd be more effective and healthier employees, and of course, maintain more stable homes for their children and young people. Much of the profit these companies currently make is sent outside our state, as Kelly said, because borrowers often use nationwide companies through internet sites. So these companies seek Missouri customers because we have fewer regulations in Missouri. And then statewide regulations would discourage this practice. Keeping money within our state benefits all of us. And I think this concludes our presentation, but we'd like to open it up to your thoughts and your questions. I know Julie Steiger has been keeping track of any of those questions in the chat.
Yes, Anne, I will tell you one question we've had is who regulates the internet loans? And we've had some people weigh in on that. You know, they were asking, is it federal? And some interesting comments. Nancy said that our legislature did address this 20 years ago, so it'd be interesting to hear how that turned out. But the only question I see is who regulates internet loans?
Yeah.
Kelly might have an answer there, or Shelby.
Oh, yeah. Well, I feel like I'm just really not sure. I feel like it's kind of like sales tax, right? They're under the federal, which is less regulation than state by state, but I'm not exactly sure, but we would be happy to do some research on that and get an answer back to everybody before tomorrow.
I
Does the
think,
Fed,
oh, sorry.
I just got to answer, does the Federal Trade Commission ever get involved with that? Any idea? Anybody?
I was just
Um,
gonna say, I think we were really surprised once we started digging how many internet loan options there were going in. We didn't realize how easy it was to borrow from the internet, and it's very hard to track which state those companies are in. And so we would have to probably look more into it. But it was something that we didn't realize going in, but it's blown up, I think.
I had a
Some other
question.
thoughts from,
Is there a federal loans from the consumer protection side?
I think there may be some
Yes.
very light regulation from the office of the comptroller of the currency. But again, since they're not banks, the FDIC doesn't really get involved except by putting very weak pressure on the banks who supply them with cash to make the loans.
I wouldn't imagine this would fall under FDIC, but something on the consumer side, consumer protection side.
Well, Julie mentioned earlier, and she is right, the Federal Trade Commission is one federal agency that has oversight, as well as the Federal Consumer Financial Protection, the Equal Opportunity Act, Fair Credit Reporting Act, but they are, like Ann said earlier, they are light. It's light regulation and light oversight.
I think too, Nancy put a comment on that if they don't have a brick and mortar home site, they're not regulated. And we certainly would agree that this study, our consensus statewide, if we adopt a position, would not solve all the problems of payday and auto title loans. What it would do is take our state forward in being able to do that. And primarily, it would take our league forward in being able to advocate for fair practices that would enable us to go forward and protect consumers while offering these services.
I have a question. I wondered, is there any data that says sort of what is the percentage of payday loans like which are taken on the internet versus a location place? Is there any kind of percentage?
Okay, my research, when I did that little table where I gave a demonstration, that 494% was pretty standard across the storefronts and the internet,
The rates are the same, but
those fees.
Marge, you're asking about, or Linda, you're asking about the number of customers, one versus the other. Where does the business land? Volume wise.
Oh, I
think
see.
that's probably beyond the scope of our study, but I'm not sure.
Yeah, and I thought it would probably be hard to find. I don't know, but I think that's a interesting question.
This reminds
And-
me of collecting sales tax on internet purchases.
Right,
It's
Yes,
the same model. It's the same dilemma.
right.
yes.
We've also had a question from Catherine. She was asking, is there no competition among the lenders?
Yes, there is. Let's see.
And I would guess there would be competition between a land-based provider and internet provider.
I'm sure there are advantages. One of the problems I think the committee saw during their research, and they can correct me if I'm wrong here, is that sometimes simply accessibility to a bank. If you don't have a bank account, if your hours of work don't allow you to leave when a bank's open, or you don't have transportation to a bank branch, and in many areas, there aren't a lot of bank branches, it becomes very hard just simply to get a loan if you could.
Sure.
Whereas these payday loan companies, whether on the internet or brick and mortar within our state, are found pretty frequently within neighborhoods so that people can walk over and their hours are longer. They accommodate people more. So again, I think what Shelby mentioned, educating people and establishing statewide alternatives to help people make other choices that are reasonable and that are regulated would be important.
Right, Marge is right. You know, the internet, sure, it's open 24/7, but sometimes your payday loan borrowers, they may not have good internet at home. They may not have a computer at home. They have to go to the library to use the computer and the internet. So that makes the storefronts remain attractive. You know, even in the internet age, the storefronts remain attractive, and they're open late like fast food. I mean, they are open and ready for business.
And I was going to add, as the spouse of a retired banker at a regular bank, I was struck by when our study committee presented, over and over again, people who use payday loans say they are so much more friendly than regular banks. Friendly at people, welcome you when you walk through the door, come on in, we want to help you. And my husband would probably disagree, but that they didn't get the same response when they walked into their regular bank.
Well, and they're probably working on commission.
Well, I did hear a story during this whole thing because, of course, I was pretty involved with it and so talked to a lot of people. But there was a woman who made payments for over 25 years and would go in every month to make a payment at her local payday loan down the street. So I think there is that familiarity with people who aren't as comfortable with financing in banks. And to them, it's just a small loan. And I don't know how many times over she paid that loan off, but she did for over 20 years. So that's just one example. But I think with the internet, it might be a better sell to legislators to do something about this because the internet sales have blown up and there is a lot of fraud with that. They might be more willing to listen and actually make statewide regulations, in my opinion, because of that.
I'd like to just say that I think y'all have done an incredible job. I think it's a superb document and a really good position. And I would very much be in favor of, adopting this as a state position.
I agree. This is a stellar job, and this is we should put this in the files of Missouri and say, okay, this is how you do it, folks. Take a look at this because you just did such a thorough job on every part of it. Good job.
Thank you so much.
I wish Marjorie West was here to hear that because this was really a lot of her initial desire to do something about this. So she wasn't able to be here, but I know she'd be so happy to hear that.
Well, it's being taped. You can give her.
Yeah. I think she'll be able to watch that on the YouTube.
Yes.
And her passion does just shine through. But I will say that now that we know so much about Marjorie and Teresa, and especially Kelly and Shelby and Ann, we're not going to let them disappear in our league. They will be called on many times.
Good job.
And we thank you for the kind words tonight.
I do want to say that Marjorie was so passionate, and it was, she was, I was like a fly drawn to a candle, a light bulb. I just wanted to be involved in it. But I also want to just give a shout out to all the members of our Southwest chapter that are involved in poverty issues. We have a lot of our members are advocating for lots of things beyond, beyond just the payday loan issue. And this was just one little piece of the ongoing support that our league members are working on in Southwest Missouri.
Well, that's very, very wonderful to hear. And I hope somewhere in some sort of report, maybe we're hearing from local leagues, you can include that statement, because the league, you sometimes you get alone sort of in the league, and you think you're the only one, and then we get so excited when we hear another league is doing something similar or identical to what we're doing, and they also have a high level of interest or concern about it. So please make sure that information about your league is shared at the state level.
I remember a number of years ago, we actually studied this in league here in Moberly. And I don't remember, it seems to me like it was Kansas City that kind of started us on that path. But I can remember personally that one night after our league meeting, when we were talking about this, I drove around town in Moberly and counted 11 of those in Moberly, a population of, less than 15,000 people.
Wow.
Are there any other comments or questions or things you would like to discuss?
This is Adele Shayer. I missed something. Is there anything in this study or talks about limiting how much the loaner, the interest that they can charge? To me, that's one of the problems. Biggest one, they charge too much.
We do know from, Shelby had mentioned Montana and some other states that implemented like a 24% or a 36%. And the reality was that small lenders were able to make it on that when they had better vetting, better practices working with people, because they weren't hoping they would default. Like a auto title thing might just rather come get your car than help you be successful in your loan. So we do have some states that did a small, we just decided to not say a specific interest rate because we knew that that might make it be easy to not get on board for the whole state. We thought if we would just say affordable credit, and then we can all work that out as we're talking to legislators and working with our own, we can work out what that word means. We were afraid that we would turn people off if we tried to take a hard line. We just know it needs to be better than it is, right? I feel like that's why we didn't say an exact interest rate. Shelby, Ann, you guys want to weigh in on that?
I would agree. I think in our discussions, we really wanted to kind of keep it open and look at some examples from other states, but not be too directive about what we should do and just kind of leave it to, deciding later. But there are so many good examples, and even the programs that offer education that are already in existence. So looking at other states, I think, is really important, and those studies and surveys that they have that show how it worked or didn't will be important too.
And
I'm
also,
very passionate about this topic. I was just going to say real quick, I'd love to just get rid of them. So this was really difficult for me because I did want to look at it very balanced and two-sided. So I had to put my personal views aside.
I think the position statement you have written allows you to work with legislators, because that's one of the things that we do, is try and find legislators interested in our issues that we can work with. And this gives you enough leeway as you continue to learn about it, and as you learn about other parts of the state more, as other people speak up, whatever, that you can do that. And I'm glad that you left it so that it's defined what you want: accessible, affordable credit while safeguarding consumers. My gosh, if somebody can't craft a bill that fits that, they're not a very good politician. So I think you did a good job on that. Good job.
And Nancy, don't you think too, I know one of our goals in work with the wording of that position was, we know that any changes will probably be incremental, and
That's right. That's
allow
right.
us to do the little things to start, and then hopefully something bigger.
Yeah, exactly.
All steps do
Is
begin
there
a journey.
is there any possibility of legislation that also tackles the banks that finance these storefront outfits and the internet outfits too? I mean, could we offer them incentives maybe to start funding, community credit unions that lend at more reasonable rates for those small dollar amounts and with shaky credit histories, and back away from the more predatory outfits?
That's a neat idea. Yeah. Banks are required by law, and of course, Ann knows this because Dana is a longtime banker. Banks are required by law to spend a certain percentage each year on community improvement things. And it has parameters, but in a way, they could already get kudos and credit from the regulators by funding some of these other things, because it would be in that thing where I know that when I was working with Drury, when I was at Drury and we were doing a commercial street project, I got a bunch of banks on board because I said, well, you got to spend that money every year anyway on, community improvement things. And so there might be a way to get banks on board to use their dollars that are for community redevelopment to fund some better programs than the payday loans. Yeah. Good idea, Ann.
This is Donna Hoke. I've been around long enough that I'm like Nancy. I remember when they first took it out of legislation that you couldn't charge more than, I believe it was 34%.
Right.
And that's when the payday loan business took off. And I remember even my church getting a busload of people to go down to the legislature to try to put some limits. In fact, I wasn't aware that it was now down to 75%, because at one time it was as high as 400%.
Well, it is on an annualized basis. It is. Yeah.
An interesting point that I remember from some of the reading that I had done is that about 25% of the population is what they call unbanked. That means they don't have a bank account or, don't a checking account, a debit card. You just don't use banks. And I know that's the case in a lot of rural areas. So therefore, obviously there would not be any option to go to the bank and ask for credit. And you can see that in the lines that form in my local grocery store at the counter where they purchase money orders to make the payments that they do for the payments that they have to make, that they send in on a monthly basis.
And what they have to use to cash a check and pay a certain percentage of that check just for getting it cashed.
Yep.
Well, I'm going to thank you all for being here tonight. We're just a little bit over time, and I'm sure people have busy evenings. And I know coming up, we have a couple of very busy days with the league. So I really appreciate your being here. And again, I thank our committee and all of you for your great questions and comments tonight.
Thanks, everyone.
Thanks,
Yeah.
guys.